the best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. Now, markets have been experiencing heightened volatility in recent months, driven by shifting interest rate expectations, geopolitical tensions, and rapid movements across currencies, commodities, and global indices. For active traders, this turbulence has created a range of short-term opportunities on both the upside and downside, particularly when using flexible instruments like contracts for difference, also known as CFDs. So how can traders navigate uncertain conditions, capitalize on price swings, and manage risk effectively? Well, to find out more, joining me now is Lim Jun Kit, who's a senior strategist at Phillip Nova. Jun Kit, welcome back to the show.
Hi, Hongbin. Thanks for having me. It's great to be back.
Thank you so much for joining us, Jun Kit. Given the recent market turbulence here, including the sharp declines in major indices and the ongoing trade tensions, how do you assess the current market environment?
The market has been volatile. Okay, so like what you rightly mentioned, the markets, be it the global stock market, the commodity market, or even the forex market, they've seen a great deal of sharp moves in the past couple of months. As we all know, after Donald Trump's inauguration and his tariff announcements, that sparked a major sell-off of risk assets at the early part of April. So while the market sentiment has improved over the last week, with the strong U.S. jobs market data and also some positive progress on a potential de-escalation on the trade war due to Trump's statements, I don't think we are quite out of the woods yet, because I think this is still a story that is still developing, with the actual impact of the tariff on the global economy is still yet to be seen.
Well, recent market swings have opened up short-term trading opportunities in various markets nonetheless. So what are some examples of short-term opportunities you've seen recently in, the U.S. dollar or stock indices?
So since January, the US dollar has been depreciating pretty steeply against some major currencies like the euro, the pound, and the Japanese yen. So if you look at the US dollar index, which tracks the strength of the US dollar against a basket of other major currencies, and measuring from the peak in January to the trough in April, the US dollar index actually slipped 11%, just within the span of these few months, dropping below the key level of 100. And at one point, it even touched the lowest point since March 2022. So currently, the index is hovering below the key resistance zone around 100. And I think if the reading stays below this level, below 100, we can continue to expect further downside on the US dollar to as low as 98 the short term. On the stocks indices side, I think the momentum have actually turned bearish for the short term, at least after rebounding sharply from its April bottom. And I think according to the technicals, if the US indices continue rising past the swing high created on, I think, 25 March, then we can expect further upside in the US indices in the short term.
Okay. So, Jun Kit, I guess, the question now is, how can active traders take advantage of the recent market volatility without holding positions long term? I mean, how can investors assess whether a market is more favorable for long or short trades?
I think instead of holding positions, long-term for weeks or even months or years, traders can actually use trading instruments like a CFD, which stands for Contract for Difference, to trade these shorter-term price swings. Traders who trade CFDs would actually enter into trade and hold a position for maybe as short as a few minutes or as long as a few weeks, so depending on their trading strategies, of course. Now, while different traders would have their own strategies and approach in reading the market, to identify their own directional bias on the market, one practical and objective approach would be to see if the prices are actually below or above some key moving averages. Like the popular moving averages are the 20, 50, or even 100-day exponential moving average. So by using this method, it gives you a basic read on the momentum based on the technicals, to see whether the buyers in control or are the sellers dominating the market.
Speaking of short-term trading opportunities, contracts for difference, or CFDs, may be a strategy to consider here. So, Jun Kit, for those new to the concept, how would you explain what a CFD is in simple terms, and what types of traders or investors typically use CFDs?
So a CFD, or contract for difference, is actually a type of derivative that lets you trade on the price movements of an asset without owning the asset itself. Okay, so you're essentially speculating on whether the prices will go up or go down, and you profit from the difference between your entry and exit price. Now, CFD, they are also a type of leverage instrument, meaning that you only need to put up a fraction of the trade's full value, which would amplify your both potential gains and also your risk. So with CFDs, you can trade a wide range of assets, including major stocks indices, individual shares, commodities like oil, or even a currency index like the US dollar index that I mentioned earlier. So CFD, they are actually popular among active traders who want the flexibility to trade frequently and in a more cost-effective way. So especially those who are looking to take advantage of the shorter-term price swings across multiple assets and markets.
Right. Then how does the ability to go long or short with CFDs give traders more flexibility compared to, traditional investing? And why might that be beneficial, especially in the current market condition?
Yeah, I think that's a good question. So the key advantage of CFDs is actually its ability to go both long and short. So you can potentially profit whether the markets are rising or even falling. So I think that gives the traders a lot more flexibility as compared to traditional investing, which typically only benefits you when the prices of the assets that you buy go up. Okay, So this is especially helpful, I think, in today's market where the momentum can really shift quickly. In the past week it's been risen up, but before that it's been tanking really sharply. So, for example, investors may hold on to their ETFs or their stocks for the long-term growth prospects. But in the short to medium term, the trend can actually turn bearish. And instead of selling their core holdings, which is for long-term investments, in the shorter term, they can actually use CFDs to go short on the assets that they have exposure to long-term and try to profit in a downtrend or even hedge against their long-term portfolio without liquidating their portfolio. So I think this makes CFD a useful tool for navigating volatility. That's what we are experiencing now.
Right. Diving into this a little deeper then, Jun Kit, what are some of the key advantages of using CFDs over, buying stocks or trading futures directly?
So there are quite a few, actually. First of all, of course, they are a relatively cost-effective instrument to trade. CFDs are normally traded on a zero commission basis. So in our case, it also applies to share CFDs as well. So that means you don't pay commission. There's also no exchange fees charges. There's no platform fees charges. So the only cost that you'll be incurring when you trade CFDs are the bid and ask spread and also the financing cost if you hold your positions overnight. And secondly, the barrier to entry into CFD trading is actually pretty low. So you can trade in fractional lot sizes. So you don't need a large capital outlay to start trading things like global indices and shares. So fractional lot sizes, low barrier to entry. Third of all, like I mentioned earlier, CFD is actually a leverage product. That means you only need to put up a small portion of the trade value as a margin, so it allows you to control a larger position with less capital. But with that, of course, with that amplification factor, it also increases your risk. So it's important to use the leverage responsibly and to apply risk management. Okay, and lastly, for CFDs, there's no expiry. Okay, so unlike futures contracts that would have a fixed expiry date, CFDs, they let you hold your positions for as long as you want without the need to roll over your contracts and to worry about those dates.
Are there any, technical indicators or chart setups when scanning for CFD trading opportunities?
Okay, this question could potentially be a very long question, like a long response to this question, but I try to condense them into a relatively short response. So when we talk about trading, especially for those who are not so well-versed, we generally recommend swing trading strategy, whereby you are analyzing the market using the minimum 1 hour time frame. So 1 hour time frame, 4 hourly time frame, and daily time frame and above. So we recommend using these kind of high time frames over intraday or scalping strategies that are essentially, looking at like 1 minute or 5 minute charts, because these lower time frame analysis tend to be, more volatile, and these setups tend to be more prone to noise that can lead to less reliable signals and, potentially more emotional trading. Okay, so a good starting point is to look at the daily chart of the assets that you're trading to identify the overall trend. Okay, and one simple method is to observe the position of the price relative to the key exponential moving average. So like what I mentioned earlier, the 20 and the 50 EMAs are the useful ones that traders will look for. So for example, if the prices are trading below the 20 and 50 EMAs on the daily chart, so that generally signals a bearish trend. So in a downtrending condition like this, these EMA lines will often tend to act as a dynamic resistance level, so capping prices from rebounding higher. So at times like this, traders can watch for prices to pull back towards the EMA, as somehow like a mean reversion, then to look out for a reversal signal, so such as a bearish candlestick pattern or even chart pattern. So this could potentially present you with a high probability opportunity to go short and ride the trend to the downside.
I think we've got a great overview of how CFD trading works here. So, Jun Kit, what are the most common risk management mistakes, though, that new CFD traders make, and how can they avoid them?
Okay, so I think a big one in this is that traders normally trade a position that is too large relative to their account size. Okay, so and that can be pretty dangerous, especially if you don't know how the leverage work. And another one is by not using a stop loss in your trade, because I think, like I mentioned in my earlier interview, there isn't a trading strategy with a 100% win rate. So wins and losses are part of the game, and the aim of it is minimize your losses and maximize your profits. Right. So to have stop losses in place, you're basically allowing yourself to cap your losses. And on the other scenario where you don't set a stop loss, basically you don't limit your losses. So that's a very bad position that we don't want to be in, right? Mm-hmm. So I think my advice is always define your risk before entering a trade, and never risk more than perhaps 1 to 2% of your portfolio on a single trade.
That's some great advice there. Well, before we wrap up this interview here, Jun Kit, overall, how should one approach position sizing and leverage when the market is highly volatile?
Okay, so I think the first step before you place any trade is, of course, to look at your stop loss level first. Okay, so there's two things that you need to identify before you place a trade. First is the entry price, and next is your stop loss level. So your stop loss level should be set at a price point where, if the prices hit it, it clearly signals that your original trade idea is no longer valid. So by having a stop loss level, it prevents you from holding on to a position for too long out of hope that it will rebound in your favor. Okay, so once you find your entry and stop loss levels, you can then calculate the difference in the price, between your entry and exit, and use that along with the dollar amount that you're willing to risk to determine your position size. Okay, so you calculate your position size based on how much you're risking in terms of the price difference between the entry and stop loss. Okay, so this way you're actually sizing the trade according to your risk tolerance and not the other way around. Okay, and I think one more important point is avoid setting your stop loss too tight or too close to your entry level. So I think especially in volatile market like this, that is because price noise can easily trigger your stop loss, resulting in premature exits, even if your overall trade direction is correct. So I think to give your trade enough breathing room while managing your position sizes will make sure that you're not overexposed and reduce your risk in general.
Definitely. Well, some great insights from you there. Thank you so much, Jun Kit, for joining me today.
Thank you, Hongbin. Thank you.
Thank you. That was Lim Jun Kit, who's a senior strategist at Phillip Nova. This has been the Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.